The next learning objective is to record materials and labor costs in a job order costing system. This is just an overview. Now that we've talked about the differences between job order costing and process costing, for the rest of the chapter we'll focus on job order costing only. Remember, job order costing is used by companies that make unique products or specialized services. A business that builds custom guitars according to customer specifications would use job order costing. Why? Because each guitar will have a different cost because each guitar is different. So we'll use Gabriella's Guitar Shop as our example. They build custom guitars, so their job order costing system will track costs per job. In other words, each custom guitar they build will need to have its cost tracked separately from all other custom guitar jobs. On this slide, I want you to visualize what's going on inside the guitar factory, but first, keep in mind that some jobs have different names. In the homework, the factory is sometimes called the production floor. So a production manager, or factory manager, or factory supervisor are three different names for the same job. Starting with the storeroom is where we first receive our raw materials. Keeping things simple, the materials in our example will only be the wood, guitar strings, and glue used to make the guitars. So when the raw materials come in from the loading dock, that's where they go, the storeroom. The T account associated with the storeroom's raw materials is the raw materials inventory account. Because this is an inventory account, it's an asset account, and therefore it increases on the left side. The support offices are where the accountant, administrative assistants, and CEO work. The factory floor, sometimes referred to as the production floor, is where the company makes the custom guitars. The ledger account associated with the guitars being built in the factory is the work in process inventory account. The cost of any guitars currently being built would show up on the debit side of the work in process account. And lastly, the sales floor is where the finished goods go while waiting for the customers to come pick up the guitar. The ledger account associated with the guitars that have been built but not yet sold is the finished goods inventory account. So the raw material cost flow will start in our raw materials inventory, flow to our work in process inventory as the guitars are being built, and then transferred to the finished goods inventory once the guitars are completed. So now I've made room for the cost of goods sold account. When a guitar is sold, the cost of that guitar leaves the finished goods inventory account and is transferred to the cost of goods sold account, which is an expense and appears on the income statement. Note that I've placed reminders on the slide that the three inventory accounts are assets and cost of goods sold is an expense. So that means, of course, that the inventory accounts are balance sheet accounts and cost of goods sold is an income statement account. Now, all these dollar amounts are costs, not the sales price that Gabriella will charge the customer. So let's review costs versus price once again. We've discussed this slide before, but let's go over it again because it's critical vocabulary. Cost versus price. You have a company that sells iPhones. The store is called iPhones Galore. iPhones Galore purchases an iPhone for $400 and wants to sell it for $500. What is the cost? The cost is $400. What is the price? The price is $500. So it's critical to understand that cost is the amount iPhones Galore pays for something, and price is the amount iPhones Galore will sell it for. And finally, price is sometimes called sales price. Another way to see these costs flow through the company is with our financial statements. On the left side, we have our balance sheet with its assets, liabilities, and equity. On the right side, we have our income statement whose formula is revenue minus expenses. And the largest expense of a manufacturer is usually cost of goods sold. So when the company orders raw materials, such as wood, guitar strings, and glue, their costs are placed in the raw materials inventory account. Then, as factory workers take wood or some other raw material out of the raw materials inventory account to build a guitar, the costs are transferred from raw materials to work in process inventory. Then, once the guitar is finished, the cost is transferred out of work in process to finished goods inventory, where the guitar waits to be sold. Once it's sold, the cost of making that guitar transfers from finished goods, leaves the balance sheet, and is placed in the cost of goods sold account, an expense account that appears on the income statement. Here's another way to look at how the cost of materials and labor costs flow through a job order costing system, this time with a bit more detail. Each job will have a job cost record associated with the job. A job cost record is a document that shows the direct materials, direct labor, and the job's portion of the manufacturing overhead costs for that particular job. On the left, we have 3 different jobs and their job cost records. Jobs 27, 28, and 29. And all of them, remember, are customized jobs to meet each customer's particular needs. Each job collects costs as it's being processed. This means that the materials are taken out of the storeroom to start the job. The cost of these materials are added to the job cost record as direct materials. The same is done with direct labor as workers work directly on the job. Later, when the job is done, the job's share of the manufacturing overhead costs are allocated to the job and added to the job cost record as manufacturing overhead. We'll explain how this is done later. As these jobs are being assembled, these costs on the job cost record show up as debits to the work in process inventory account. This means that the job cost record is showing the details of the costs of work in process jobs. Once the goods are complete, we call these costs of goods manufactured, and they are transferred out of work in process inventory to finished goods inventory. This is done by decreasing our work in process inventory account with a credit and increasing finished goods inventory with a debit. Once the goods are sold to customers, the customers are moved off the balance sheet to become cost of goods sold. We credit finished goods inventory to remove the product from the balance sheet account, and then we debit cost of goods sold. By debiting cost of goods sold, we are increasing this expense account. And of course, expenses like COGS appear on our income statement.